Hello and welcome. I'm glad you're here for what I think is the most interesting forecast that we've published during my tenure here at WPP. This is the mid year edition of This Year Next Year. We publish in June and again in December. And the June edition is always the one where we take stock of the big picture, where the next 12 to 18 months are headed, sometimes even longer than that, 5, 10 years out, based on the external drivers impacting our industry from government regulation through to technological advances like humanoid robots. That's right. This is the Media Intelligence podcast from WPP Media. And today we're digging into our newest forecast this year, next year. Well, so much has happened in the last 6 months since December's forecast, and that has meant a significant upgrade to our predictions for this year. But I want to start with an analogy that runs through the entire report because I think it's a very useful frame for everything that follows. And that is the California Gold Rush and Manifest Destiny. Cast your mind back into the mid 1800s. The world was experiencing major disruptions, revolutions in Europe, the Taiping Rebellion in China, and yet California was booming. Capital flowed west, people followed, and the infrastructure built to serve that rush, the railroads, the ports, the financial systems, that outlasted the rush itself and became the foundation for a century of American economic power. I think we're living through something with a similar shape. The goal this time isn't gold, it's artificial general intelligence. And the infrastructure isn't railroads and canals, but it's data centers and power grids. The geographic center, though, just as it was in the 1850s, is still California. That's the lens for the forecast. Let's get into it. So let's start with the top line. Where are we? Global advertising revenue, excluding US political advertising, is now projected to grow 9% in 2026. That's a significant upgrade from the 7% we had predicted in December, just 6 months ago. In the United States, we're upgrading to 12% growth, up from 7% in December's forecast. And if you include political advertising, and it is a midterm year this year, US growth reaches 14%. Now, I want to pause on that for a second because I think these numbers deserve context. We are growing faster than predicted despite armed conflict in Iran and the Middle East, despite elevated oil prices, despite persistent geopolitical fragmentation, and frankly, some pretty negative consumer sentiment around the globe. So, how? Well, there are three key engines of growth that are underpinning that optimism. The first is the Chinese export economy, the second is the AI investment cycle, and the third is a media universe that is ever more concentrated among AI enabled digital platforms. I'm going to unpack all of that throughout the podcast. Here's another headline number that I think is remarkable from the report. Global advertising revenue as a share of global GDP is now at the highest point since we started our data and recording back in 1999, surpassing even the dot-com peak of 2000. But there's a difference this time around. The 2000 peak was driven by brand exuberance, sort of unmeasurable speculation. Right now, I think we're more grounded in measurable performance, an expanding advertiser base, and a structural shift in how consumer access to digital services is funded. Advertising is increasingly the economic mechanism that pays for the internet, and that has big implications going forward. One more number worth sitting with. The top three advertising sellers outside of China, Alphabet, Meta, and Amazon, now represent nearly 58% of total ad revenue outside of China. The top 25 sellers globally account for 3/4 of total advertising industry. And one other thing, the Paramount Warner Brothers Discovery tie-up hasn't closed yet. So if we assume they are still distinct entities, then there would not be a single traditional media seller in the top 10 as of 2025. If you do count Paramount Warner Brothers as a single entity, they would sit in the number 9 position. There's also a big shift in terms of the locus of those major companies in the top 10. Even including Paramount Discovery, you have 5 that are US based and 5 that are China based. That's a big sort of shift and reckoning for that top set, with those Chinese platforms taking half of the top 10 slots. It colors really everything else we're going to talk about throughout the forecast. This dual power system. Before we get into channels and regions, I want to walk through some of the organizing themes of the forecast because they really help to frame everything else. Now, the first one is all about this sense of the rush, the sort of feeling that it's a race to get to artificial general intelligence, that if we slow down, someone else will get there first. That sense of the frontier is very much, I think, in the ethos of not just Silicon Valley, but more of the tech industry itself right now. AI investment is one of the key drivers of advertising growth globally right now, not just from AI companies advertising themselves, though that is real, and we're seeing more new companies spring up. Because of the creative disruption that AI is enabling, but also from the productivity gains, cost structure transformations that AI is enabling across other parts of the economy and other advertiser sectors. And this investment has proven pretty resilient to the geopolitical shocks that in a pre AI world might have compressed some of those advertising budgets. Now, the next theme is all about advertising's role in the wider global economy. The companies at the center of the AI race are sellers of advertising. They are digital services providers offering search, communication, commerce, entertainment, and increasingly AI powered assistance to billions of consumers, often subsidized by AI. Now, this isn't true of all of them. Of course, Anthropic still doesn't have an advertising business. But if you look at Meta and Google and Microsoft, Apple and OpenAI, all of these companies do sell advertising. And as AI rolls out to consumers globally, advertising, we believe, will be a primary economic mechanism that continues to make those services affordable at scale. So, as an industry, we are not just observing this AI transformation, but we are an active participant in it. The third theme is really all about data. You can liken this to the gold rush. The most successful people weren't those with the most land, but certainly those who had the best understanding of where to find gold within that land. Now, the walled gardens, Google, Meta, Amazon, Apple, TikTok, and the likes certainly have some valuable data territories in the advertising economy, but the future doesn't necessarily belong exclusively to those who own the walls, right? There is a huge benefit in being able to bridge across those walls and connect first party advertiser data with platform intelligence in ways that are privacy safe, interoperable and decision ready. Now, let's jump into some of the key findings. Let's talk about where the money is moving. Intelligence. If you'll remember, last year we rejigged the advertising forecast to bucket everything up into four main categories. Those are content driven advertising, commerce driven advertising, location based advertising, and intelligence. Intelligence now includes two subchannels. The first of those is traditional search, and the second is generative search. This is a brand new channel for us this year. It captures advertising revenue from AI mediated discovery. This is ads served within Google's AI overview, AI mode, and standalone products like ChatGPT. Traditional search is still growing. We have to make sure we say that here. We forecast more than $267 billion of ad revenue this year in 2026, up 8% over 2025. But the dynamics beyond this are shifting. In markets where AI overviews are live, we're seeing meaningful shares of queries resolving in zero-click answers and commercial queries holding up a little bit better in terms of those that still have click-throughs. Now, generative search is a feature in this. Of course, we're expecting more than $5 billion in advertising revenue in this channel in 2026, growing to $32 billion by 2028 and more than $100 billion by 2030. That would be, if our predictions turn out here, the fastest scaling new advertising channel that we have ever measured, at least again in my tenure here. So faster in revenue terms than streaming TV, which still won't quite reach 100 billion within our forecast period. Faster than social, faster even than retail media, which has been quite the growth story over the last several years. Now, within this new category of generative search, the US dominates about 3 billion, reflecting the early availability of OpenAI's ads in the market and Google's AI mode rollout within the US as well. China is second, driven by Baidu's AI integration, ByteDance's Daobao platform, which QuestMobile says has reached 159 million monthly active users. I do want to flag one thing for advertisers. The pace of change in this channel is genuinely outstripping some of those traditional planning cycles. Google's AI surface area is expanding faster in some cases than advertiser feedback and reporting are, which means that as companies opt into AI Max, Performance Max, broad match campaigns that enable inclusion in things like AI mode, that we are still waiting for some of the more granular reporting and targeting to come along with that. But I'm sure more will be said about that in the coming months as well. Let's dig into social and the open web, other digital platforms. We are projecting 465 billion in 2026, growing 13%. Now represents 37% of total advertising revenue globally, and that is the single largest channel in our forecast. Three things, major drivers of this at any rate: AI driven optimization, improving advertiser reported outcomes. Meta has shown this in terms of their ability to price that in as well, with 10 consecutive quarters of impression price increases, which is pretty remarkable. We're seeing continued strength from cross border Asia based advertisers, including Temu, Alibaba, and Shein, really using social as an acquisition driver for expanding into international markets with their commerce platforms. And then you have the continued conversion of social engagement into commerce as well, especially with platforms like TikTok, all helping to drive continued growth. Again, even though it is already the largest channel in our forecast, we are anticipating some deceleration into 2027 and onward. That might come from some time spent plateauing in certain markets, sort of longer term, some of the age related access restrictions that are starting to take place in markets around the world, and potentially from competition as AI chatbots compete for the sort of curiosity and discovery time that has historically been with social. So we mentioned commerce there and a few commerce platforms. Let's transition into that channel. Retail media, as we said last year, surpassed total television in 2025. That means the ads you see on Amazon, Walmart, and Instacart now earn more in ad revenue than all of TV, including both linear and streaming. We are forecasting the global commerce advertising at nearly 200 billion in 2026 and growing to more than 218 billion in 2027. China's retail media market is the world's largest at roughly 80 billion and also the first to show what maturity looks like. Growth has decelerated there to under 3% this year. And the Chinese platforms that really built sort of modern retail media like Alibaba and JD are in some cases losing share to more social commerce options on Douyin and Xiaohongshu or RedNote. Critically, those Chinese platforms are continuing to export their models globally. We see this in the form of Joybuy, which has been buying up warehousing space in Europe to compete more directly with Amazon on logistics and delivery. We see it with Temu and Cainiao from Alibaba as well across Africa, the Americas, and the rest of Asia as well. One of the big unresolved questions for this category is certainly agentic commerce. When a consumer delegates a purchasing decision to an AI agent, who owns that customer relationship? When the purchase journey begins outside of the retailer's own surface, whether that's in ChatGPT or Google, who arbitrates that moment of intent? How is attribution agreed upon down the pike when we get to reporting? And that is a major question, I think, that every retailer is actively wrestling with. Note on methodology here for us, agentic search or commerce search that happens even using an agent within those retail platforms. So with Walmart Sparky or Amazon's Alexa, those do still count as commerce media revenue, retail media revenue for us rather than generative search. Those lines are obviously very, very blurry, and we're going to continue to assess where that revenue sits as we see more and more data start to come out from these platforms around what that looks like for them in terms of revenue share and how easy it is to track that. Moving into television, total TV reaches 169 billion in 2026, essentially flat compared to last year. Linear TV, especially in more mature markets, is in managed decline. Streaming still growing. And those two are gradually converging. The big 2026 event is the FIFA World Cup happening right now, of course. In Brazil, linear TV is forecast up double digits, helped by the World Cup there and the changing rights situation. Mexico, as co host, anticipating nearly 8% growth. These are extraordinary numbers for a medium that has, of course, been seeing viewing activity shift to streaming more and more. But this year, boosts in a number of markets really helped by the World Cup, where rights in many markets still remain with linear TV platforms. There is another milestone in the US as we look at this dynamic between linear and streaming, and that is that in 2026, streaming ad revenue will surpass linear in national TV for the first time, we anticipate. That matches what we've been hearing from a lot of the large media owners as well. Disney effectively said in their Q2 earnings that more entertainment revenue is coming from streaming now across ads and subscriptions and everything else than it is from linear. So this is the crossover point that we've been forecasting for years, sort of now here on our doorstep, at least in some markets or the first of those markets. Let's talk about out of home. This is another channel that is definitely benefiting from the World Cup and all of these people being in stadia and in cities across the US, Mexico, and Canada. We also saw it with the Winter Olympics in Italy with a boost to out of home in that market as well. It is sort of this structural anomaly in the forecast, right? It's the only quote unquote traditional media channel holding its own share of advertising revenue over a long period of time. We forecast $57.5 billion in 2026, up 5%, with digital out of home growing faster at 8% and now representing more than 40% of total out of home. So why is it holding up when print, linear TV, and terrestrial radio are all in decline? Well, we think it still offers something unique, right? Mass, simultaneous audiences in physical environments with creative impact that fragmented digital channels and with their personalized feeds and sort of infinite scrolls increasingly can't match. So as attention fractures and AI mediated discovery narrows where and what actually reaches consumers, the ability to put this impactful creative in front of millions of people at the same time is seemingly becoming more valuable, not less. And so that continues its position over the next 5 years as well. Now, one of my favorite things about the June forecast, and we hinted at this at the top, is the longer horizon window we take in terms of assessing the market. We do a pest analysis every June that is looking at the political, economic, social, and technological drivers of the advertising industry. And the report really gets into the harder, longer term questions that our industry needs to ask itself. So I'm going to reframe these somewhat as open questions. And if you have thoughts on what the answers should be, please do get in touch. Let's start with the sort of political, legal, and regulatory questions facing the industry. The first is sort of who manages access to audiences and who pays for that privilege, right? We are seeing age verification laws now pop up in multiple markets. Australia was the first with their under 16 ban, already in implementation. The US has a patchwork of state laws Greece, Norway, France, Spain, the UK, markets in Asia as well have all moved in this direction. So there's a mechanical question here, which is, where does that age verification happen? Who has that responsibility? Is it at the app level or the device level, more through Apple and Google? And that does determine, in some cases, who holds that identity data, who bears the compliance cost, and who controls audience access in those markets. And it creates an impetus on advertisers to really understand what that patchwork looks like and make sure that activations are within the guidelines in all of the various regimes around the world. So definitely adding to the complexity there and a lot of benefit for help in orchestrating that across many markets. One of the more consequential legal shifts in the midterm is happening, certainly in US courts and elsewhere in the last 6 months, we had two verdicts, one finding Meta liable in New Mexico, one finding Meta's companies and YouTube liable in a bellwether social media case in Los Angeles around product design and liability due to that product design. So now I should mention that companies are appealing in both cases, but the initial court cases have finished. And it really took a page in terms of not looking at the posts themselves, which have been protected by Section 230, especially in the US, but looking at the product design or the product itself as the thing in question. Things like algorithmic recommendation, infinite scroll, variable ratio reinforcement, which is similar sort of to slot machine mechanics, and juries so far appear receptive. So the open question here is, if platform design is treated as product liability, does the cost structure of social platforms converge with publisher economics, which have always had journalistic and ethical standards, lots of upfront costs for content and upfront costs for editorial control? And what does that do to margins, inventory, and the competitive balance going forward between platforms and publishers? There are other open questions about further consolidation. So M&A is a big theme across every layer of the stack, from ad tech and chips and AI businesses through to media owners. Paramount and Warner Brothers Discovery, combining, as we already mentioned, Meta absorbing AI talent and tools. In Europe, where just recently the combination of M6 and TF1 was shut down, there have been some signs early this year that the competition authority will be more amenable to allowing scale at the pan-European level in order to be able to compete with these large, globally scaled companies coming out of the US and China. So, really interesting shift there, one to watch. And especially as, again, we have companies like Joybuy from JD going into Europe in terms of factories and logistics. So the open question here is, with Chinese companies exporting more than just physical goods, but also more of their infrastructure and business offerings, how does that continue to change the advertising relationships across Europe and globally? One we'll be watching over the next 6 months as well. And then the longest arc, the most speculative element in the political section of the past is one worth just taking a moment with. And that is, as we said, that these big platforms that are now the largest sellers of advertising offer a lot of consumer digital services for free or subsidized by advertising. Things again like communication and commerce, entertainment. And the question is, how far do we go, even beyond things like AI assistance? And at what point do those get to be so scaled that it's hard to regulate from a government position? And are governments able to take up the slack where platforms have created private functions and structures for a lot of these services. And so that's one to watch on a longer term scale. Within the economic analysis, we're talking about how resilient growth is, short term and long term, and where that may eventually net out. Of course, the conflict in the Gulf, the news has changed nearly every day, it feels like, which has made it very challenging to be a forecaster during this period. Of course, no more so than being a resident within those areas that are currently within conflict. But it has triggered a significant shift in oil prices and knock on effects to things like food, plastics, fertilizer. And there is, of course, this question of how resilient or how has the world been so resilient and how long is that set to continue? Our base case does not predict a global recession this year. There are likely to be knock-on impacts into next year, and you'll see we're projecting a significant deceleration into growth next year in 2027 as we expect some of the longer-term effects of this temporary closure of the Strait of Hormuz to flow into the economy. But we anticipate that advertisers, manufacturers have hedged and are continuing to be relatively resilient despite the impacts that that has driven. Some of the other scarcity elements beyond oil and fertilizer are tied to this AI race that we discussed at the top. Things like compute, energy, metals, data. These are going to be very consequential for the further development of AI, and watching the dynamics in terms of access to those inputs is going to be quite important going forward, and something that the advertising industry increasingly will need to take stock of as the companies building these AI platforms are using that to also power their advertising systems. So, can AI native surfaces sustain, premium pricing and or just availability and scale given the premium on the cost and the availability of some of these elements? Within social, I spend a lot of time in the report talking about why live events are booming in an algorithmic world. People are spending lots of time in a digital sense in private AI mediated environments, and then also paying premium prices for concerts and sports and festivals. We are anticipating that the desire to be with other people, to experience things together, this concept of collective effervescence, which the philosopher Emil Durkheim coined, is going to be important, especially as we see more and more of our interactions mediated by AI. So, fandom as a primary organizing structure of social identity, right? Potentially with sports filling some of those roles that maybe once were held by religious and civic institutions that have seen participation or importance declining in many major markets. And so, for advertisers, the question is, how do you engage in that authentically and tap into some of that meaning and cultural identity for people that is increasingly organized around shared physical experiences? And finally, technological. This is really the crux of so much of what we're talking about in the report as a whole. I'm just going to pick on one of the themes here, which is the concept of new surfaces. So we've, within the advertising world, always evolved in sort of lockstep with the surfaces on which human experience unfolds: radio, television, the web, mobile. We are entering sort of the next transition into more ambient experiences, I suppose: autonomous vehicles, AR glasses, home displays, physical robots, even. And what currently unites all of these things together is that none of them has an established creative language yet, right? The grammar of what good banner ads are, or what web displays should be like, took a long time to mature. Social video advertising is still being refined. Things like augmented reality, advertising in autonomous vehicles, potentially ambient display in the home, advertising, audio advertising for things that are not viewed through a screen interface. We're still drafting sort of those creative conventions of what's going to work for humans and make it, uh, you know, a value add experience for them and effective for advertisers. So, what does that look like? And surely this will be an area where uh, humans leading that exploration and understanding the spatial sense is going to be super, super important. So, that is the bulk of a lot of the deep analysis of the report. We can go over a couple of headlines from the regions. North America growing more than 11%, close to 12% this year. Europe at 7%, APAC also 7%, Latin America the fastest this year at 13%, Middle East and Africa, of course, facing the most direct impact from the conflict in the Gulf, is anticipating close to 6%, which is down from the 8% we had predicted in December. But we're anticipating a swift recovery once the hostilities have resolved. So let me close where the report does, which is with a concept I think the 49ers would have recognized. And that is of a feeling that history has concentrated itself into a single place and a single window, that the ordinary rules of caution and pacing do not apply, that those who stand still will fall behind. And that maybe feels to a lot of us, especially that pace, the drive to do things faster and faster, something maybe that we're all feeling very familiar with today. But manifest destiny as an ideology led to really tremendous harm in certain corners, right? The conviction that a certain future was inevitable made it easy for some to treat the costs as acceptable. The advertising funded internet of the past couple of decades has produced certainly extraordinary consumer benefits with free access again to things like entertainment and communication. And pieces of that incentive model also produced some of those optimization metrics that we now look at as, sort of belatedly in courtrooms around the world as being something that was maybe not the best incentive model. The lesson I think for all of us is not that ad supported models are inherently flawed, but that those incentive structures within the products themselves matter enormously. Things like conversational AI, agentic commerce, ambient computing, the new surfaces ahead that are likely to incorporate advertising and will be in some part funded by advertising, make it imperative that we as an industry ensure they are designed for sustainable, trust based relationships between brands, platforms, and the people they serve. The choices that we make within the industry over the next 24 months, I think, will help determine the shape of our future for the next decade. And unlike the 49ers, we have the benefit of knowing what happens when you work to design the future you want rather than just expect it to happen to you. Thank you for listening. You can read more about the report on our website. As a reminder, this year, next year, and the Media Intelligence podcast are meant for informational and entertainment purposes only and are not financial advice.